In a dramatic realignment of global energy pathways, China's imports of U.S. crude oil have plummeted by nearly half, reflecting not only a shift in the nation's energy preferences but also a broader transformation in global oil markets. According to recent data from Compare, China imported just 81.9 million barrels of U.S. crude in 2024, a sharp drop from 115.6 million the previous year, marking a 46% decline. As a result, China has fallen from being the second largest buyer of American oil to the sixth largest. Below, we examine the key drivers behind this significant downturn and the ripple effects on the global oil landscape. The shift in China's oil import strategy. China, the world's largest oil importer and the second largest oil consumer, has historically sourced crude from a wide array of suppliers to meet its vast energy needs. However, recent reports reveal a 7.2% year-over-year decline in China's total crude imports. This reduction is partly due to periodic COVID-19 lockdowns, abundant domestic inventories, and planned refinery overhauls. Despite this drop, China has adjusted its purchasing strategy, opting for more favorable or flexible terms when acquiring oil. Official customs data show a noticeable pivot away from certain Western producers, highlighting Beijing's multifaceted approach to securing cheaper oil and enhancing its energy security. The rise of discounted crude supplies. Recent figures from Compare indicate that the share of China's oil imports from Russia, Iran, and Venezuela has grown from 24% to approximately 26%. While this increase might seem modest, it signifies a substantial rise in absolute volumes, given China's massive import base, which can exceed 10 million barrels per day. Russia, facing Western sanctions, has been offering steep discounts on its Urals crude, making it attractive to Chinese refiners seeking to reduce input costs. Similarly, Iran, still under U.S. sanctions, continues to supply crude to China through various methods, such as masking the oil's origin via transponder shutdowns and ship-to-ship transfers near Malaysia or the Persian Gulf. Venezuela, also heavily restricted by U.S. sanctions, maintains its oil exports to China through complex payment schemes and third-party intermediaries, but the low prices remain appealing to China's cost-conscious refiners. Collectively, these discounted sources are filling the gap left by declining Western shipments and further entrenching China's ties with diplomatically isolated oil suppliers. Key drivers behind the realignment. The shift towards discounted or sanctioned oil suppliers is driven by a combination of financial and political motivations. Economically, Chinese refiners benefit from significantly lower prices for crude, allowing them to maintain profitable margins. These savings can be used to either subsidize domestic fuel prices or bolster refined product exports, especially within Asia. On the political side, diversifying its sources enhances China's energy security by reducing dependence on any single supplier, thereby limiting vulnerability to geopolitical instability. Moreover, China's increased reliance on sanctioned producers like Russia, Iran, and Venezuela enables the nation to strengthen diplomatic and trade ties with these countries, which are eager to find new markets for their oil in the face of Western sanctions. This approach further solidifies China's position as a global power that is willing to operate beyond the confines of U.S.-dominated policies. Tracking and trade dynamics. The trade of sanctioned oil to China involves intricate tracking and surveillance. Analysts from organizations like Compare and Vortex use satellite imagery, AIS data, and port records to monitor ship movements. This data uncovers tactics such as turning off AIS transmitters and conducting ship-to-ship transfers, often near Malaysia's coast, to obscure the true origin of the shipments. Chinese customs reports may not fully capture the volumes of Iranian or Venezuelan oil, as some shipments are falsely labeled as coming from countries like Malaysia or Oman. However, the noticeable increase in these arrivals suggests a strategic effort to take advantage of price gaps. Though a 2% shift in import origins may seem minor, it represents billions of dollars rerouted in trade and a significant shift in global maritime trade routes. It also exerts downward pressure on traditional exporters, like Saudi Arabia, Angola, and Brazil, forcing them to adjust their official prices to protect market share. Wider consequences for global oil markets. China's evolving purchasing patterns are reshaping the global oil landscape. The growing share of deeply discounted crude from sanctioned countries calls into question the effectiveness of Western sanctions and highlights the loopholes that allow oil to continue flowing despite restrictions. By focusing on these cheaper supplies, China can influence global oil prices and market sentiment, particularly if this trend persists. For established suppliers, China's bargain hunting could spur competitive pricing adjustments and shifts in contractual conditions. The situation is especially challenging for Russia, a key member of OPEC+, whose discounted exports to China undermine the group's efforts to maintain higher global oil prices. As China strengthens its ties with sanctioned oil producers, it could redefine global alliances, positioning itself as a pivotal energy consumer willing to operate outside the constraints of Western-led norms. This move not only secures cheaper supplies for China, but also enhances Beijing's leverage in global commerce and diplomacy, potentially setting the stage for deeper shifts in global energy markets and international relations. The rise of electric vehicles and renewables. China is rapidly embracing electric vehicles, EVs, a trend that is directly impacting its oil demand. As more Chinese motorists opt for EVs, the government is advancing electrification in both transportation and industry. This shift may reduce long-term oil requirements. Additionally, the increasing adoption of cleaner fuels, such as liquefied natural gas, LNG, is further diminishing reliance on oil-based energy sources. China's growing economic alignment with BRICS countries, chief global oil producers, has significantly reshaped global energy flows. This is especially true as Western nations impose sanctions tied to geopolitical tensions. In particular, the energy trade between China and Saudi Arabia has deepened over recent years, transitioning from oil to broader collaboration in renewable energy and technology investments. Saudi Arabia has long been one of China's leading crude oil suppliers. In 2023, bilateral trade between the two nations reached approximately $107.23 billion, with a significant portion attributed to oil exports. However, beyond traditional hydrocarbons, both countries are investing in renewable energy. Saudi Arabia's Vision 2030 aims to diversify its energy mix, targeting 50% renewables by 2030. Chinese companies play a pivotal role in this transition. For example, in August 2024, China Energy Engineering signed a $972 million contract to build a 2 GW photovoltaic solar power plant in Saudi Arabia, collaborating with Saudi entities including the Public Investment Fund and Aqua Power. Additionally, in July 2024, China's Sungrow Power Supply entered into an agreement with Saudi Arabia's Al Jazz Holding to develop an energy storage project with a capacity of up to 7.8 GW, enhancing the kingdom's power grid stability. In November 2024, China selected Saudi Arabia for its first US dollar sovereign bond sale in 3 years, planning to issue up to $2 billion in dollar-denominated debt in Riyadh. This move underlines China's support for Saudi Arabia's Vision 2030 initiative and signals a deepening of economic ties between the two countries. The impact of geopolitical tensions. Following Russia's 2014 annexation of Crimea, Western nations imposed sanctions targeting key sectors of the Russian economy, including finance, energy, and defense, and, in response, Russia pursued an eastern turn, strengthening economic and political ties with Asia-Pacific nations, particularly China. This shift deepened after the Russia-Ukraine conflict, which led to even harsher Western sanctions intended to isolate Russia economically. As a result, Russia began offering discounted energy resources, particularly crude oil, to China. By 2023, bilateral trade between the two countries hit a record $240 billion, with energy exports playing a pivotal role. In 2024, China completed the Power of Siberia gas pipeline, enhancing its access to Russian natural gas. This is part of a broader strategy to diversify energy sources and ensure long-term energy security. Moreover, Russia is discussing ways to increase its gas exports to China through projects like the proposed Power of Siberia 2 pipeline, which would redirect gas supplies originally meant for Europe. China-Iran energy relations. China's oil relationship with Iran has also been shaped by global sanctions. Despite US-led efforts to curb Iranian exports, China continues to obtain Iranian crude at discounted prices. These transactions ensure China's access to affordable energy while providing Iran with a vital revenue source. In October 2024, the US introduced new sanctions targeting Iran's oil and petrochemical industries to limit its ability to finance missile development and other military pursuits. China and UAE trade relations. China's energy trade with the United Arab Emirates, UAE, has expanded significantly in recent years, solidifying a strong partnership. In 2022, the UAE exported approximately $17.4 billion worth of crude petroleum to China, a major component of their bilateral trade. That same year, the UAE's petroleum gas exports to China were valued at around $4.12 billion, underscoring the energy-centric nature of their relationship. By 2023, overall trade between the two countries reached approximately $95 billion, with non-oil trade accounting for $83 billion, a 7.5% increase compared to 2022. Both nations aim to elevate their bilateral trade to $200 billion by 2030, demonstrating their commitment to deepening economic ties. Strategic partnerships have been key to this growth. Under China's Belt and Road Initiative, China National Petroleum Corporation, CNPC, has built strong collaborations with the UAE, particularly with the Abu Dhabi National Oil Company, ADNOC. In July 2024, the China National Offshore Oil Corporation, CNOOC, signed a strategic agreement with ADNOC to enhance cooperation in oil and gas exploration, production, and the trade of crude oil and liquefied natural gas, LNG. These agreements emphasize their mutual interest in strengthening energy trade. In addition to traditional energy sectors, both the UAE and China have focused on renewable energy initiatives. They have signed agreements to promote investment in green development, aligning with shared goals of sustainable energy. China's expertise in solar technology has boosted exports of solar modules to the Middle East, supporting the UAE's renewable energy ambitions. Economically, China has been the UAE's largest trading partner for several years, with the UAE serving as China's largest export market and second-largest trading partner in the Middle East. Chinese investments in the UAE have surged by over 16% in the past year, reaching $1.3 billion, while UAE investments in China increased by 120%, accounting for 90% of all Arab investments in China. Implications of China's energy trade and geopolitical shifts. China's growing energy ties with Russia and Iran have significant implications for its trade in U.S.-sourced energy. The availability of cheaper oil from sanctioned suppliers like Russia and Iran provides China with economically attractive alternatives, reducing its reliance on U.S. crude. Geopolitical factors are also at play, as Beijing seeks to diversify its energy sources and minimize exposure to Western diplomatic pressures. China's partnerships with Russia and Iran go beyond just energy. They are part of broader political and commercial strategies. By strengthening these alliances, China aims to reduce Western influence and enhance its autonomy. This approach aligns with China's Belt and Road Initiative, designed to expand its global influence through infrastructure projects and trade agreements. Impact on the U.S. economy. A decrease in Chinese demand for U.S. oil could lead to a surplus of crude on the U.S. market, potentially lowering domestic prices. This would reduce revenues for U.S. oil producers, impacting investments and job creation within the sector. Additionally, if Chinese oil imports continue to decline, the U.S. trade deficit could widen, affecting other economic indicators. The ongoing U.S.-China tariff conflict has prompted China to diversify its energy sources, reducing dependence on American crude. This shift highlights the complex relationship between international politics and economics. China's evolving oil import trends. Over the past 4 decades, China's oil import trajectory has mirrored its rapid economic expansion and growing international influence. Once a net oil exporter in the 1980s, China became the world's largest crude importer by the late 2010s, driven by industrial demand and a booming consumer market. The shift began in the early 1990s when China transitioned from a net exporter to a net importer, following economic reforms and a manufacturing boom that outpaced domestic oil production. By the early 2000s, China's energy demand surged, especially after joining the World Trade Organization in 2001. Its imports reached over 4 million barrels per day by the end of the decade. Infrastructure investments in pipelines and refineries prepared China for even higher import levels. By 2017, China surpassed the U.S. as the largest crude importer, with steady increases in imports from Russia and Africa, decreasing reliance on Middle Eastern oil. By the close of the decade, China was importing nearly 10 million barrels per day, cementing its role as a central player in global energy markets. Despite the pandemic's impact, China's oil imports remained robust, averaging about 11 million barrels per day. By 2023, imports peaked at 11.3 million barrels daily, fueled by a strong economic rebound. China's shift in energy and geopolitical strategy. China's move to cut or halt U.S. oil imports while strengthening energy relations with Russia, Iran, and other BRICS nations signals a shift in its energy and geopolitical strategy. This realignment highlights China's goals of securing energy supplies, minimizing costs, and forming alliances with countries that share its political interests under the BRICS umbrella. Western sanctions on Russia, particularly due to the Ukraine conflict, have opened the door for China to purchase cheaper Russian oil, reinforcing this transformation. China's increasing imports from Iran also contribute to a broader energy base, further insulating it from U.S. trade policies or political disputes. These alliances not only stabilize China's energy security, but also offer a potential to engage in non-dollar transactions, weakening the U.S. dollar's dominance in global trade. Adverse impacts on the U.S. A decline in Chinese demand for U.S. crude could disrupt the domestic oil market. Historically, China has been a major buyer of American energy, and reduced demand could lead to an oversupply, resulting in lower prices. This would negatively impact profit margins for U.S. oil producers, potentially slowing investments and reducing job opportunities within the sector, including in transportation and refining. On the diplomatic front, this shift diminishes U.S. influence in the global oil market, as China strengthens its ties with BRICS nations. These alliances are contributing to the creation of an alternative economic framework that challenges U.S.-led systems. BRICS nations' efforts to develop parallel financial institutions and reduce reliance on the U.S. dollar could gain momentum, as China reduces its imports of U.S. crude. This would undermine a key tool of U.S. economic power. Additionally, decreased Chinese demand could exacerbate the U.S. trade deficit, as oil exports have been one of the few successful areas of bilateral engagement between the two countries. Conclusion: China's shift toward BRICS partners and away from U.S. oil imports represents a significant strategic and economic recalibration. This change impacts both China's energy security and the broader geopolitical landscape, reducing U.S. economic leverage and shifting the balance of power in global trade. The heightened tensions between Washington and Beijing only add complexity to the evolving dynamics of international energy trade. Thank you for watching this video. If you found this content insightful, please consider liking and subscribing to stay connected. Your support is invaluable to us. Feel free to check out another video on our channel now displayed on the screen.